Welcome to Stock Talk with Nico Kritikos. Today we're going to be going through Zendesk stock. This is not a stock that I own, but it's one I've been researching for the last couple of days, and it is a popular one out there. And over the past year, this stock has fallen a little over 20%. It topped out at around $155 a share last April, and now we're sitting at $116. The market cap on this company is $14 billion, and they are one of the leaders in CRM software. They use cloud-based software to help businesses and organizations better connect with their customers through email, through messaging, through different types of phone calls, through different chat systems, all that different stuff. So today we're going to do breakdown of the stock and the fundamentals of the company to see, is the stock in a healthy position? Are they growing? Do they have a good moat? And how is the valuation of the stock looking right now? So first up on the list, we have pretty much what I said. Zendesk offers software to improve customer service for companies that utilizes phone, email, messaging, social channels, and more for better communication with their customers. For 2022, the company is guiding for $1.7 billion of revenue or 31% growth. So this is a nice growing company, but the valuation still seems a little bit high in my opinion, but that's up for you to decide. And I mean, they do have a lot of strong points. So one of those strong points is the fact that they have over 100,000 customers. They have big companies like Uber that works with them. I know there's casinos that I've messaged in my area that also use this when they email back and forth. So I think it does provide some value to a lot of the companies out there, especially the larger companies. But so if we look at my checklist here, we can see the first thing is that the stock is down. It's down over 30% from its highs. So that's going to get a yes. Okay. Next up, revenue increase. I put yes because they did 1.3 billion in 2021, which was 30% growth, and they're expected to maintain this 31% for this year too. Net income, if we look at net income, it actually has not been improving the way I would like it to. Most growing companies, though, normally have this problem while they're scaling up and spending so much on marketing and sales. A lot of that, pretty much all their operating cash flow or gross profit goes towards that sales and marketing. So as you can see, for the last 7 years, this company has reported negative earnings, and it really has just gotten worse. So that's not really a good trend to see. So that's going to get a no. Real quick, I do want to show you in their 10K. Well, we'll come back to that. We're going to come back to that. Next up, we have does it trade at a healthy price to sales for 2022? So the price is, you're paying $14 billion. And this is a company which is a price to sales of 8 for a company that does what, $1.3 billion of sales. So that's a price to sales of 8 for a company that's growing 27%, or 27 or 30%. I think that number should be 30%. Let's see. That's not right. Yeah, they did. Let's see. 1.7 divided by 1.3 is actually rounds it to 31%. So this is more like 31%. So yeah, price of sales of 8. That means I would like to have, I think the company is fairly valued. If they were growing at about 16%, that would be fair value. So 31% exceeds expectations, and that's going to get a yes. That's in a healthy position. But however, if you base it off of a price to earnings metric, paying 14, so you have a $116 share price, right? $115 share price. And last year they did 63 cents of EPS. And this year they're expected to do 80 cents of EPS. Both of those numbers are very low. For a stock over $100, that is a extremely low number. So that's going to get a no, because that's a forward price to earnings of 145, right? With 33% growth. So that's not really that good. I would like to see, I think it'd be fairly valued at around, if the forward PE should be about a 70. If it was around a 70, then I would say that's a fair value. So on that metric, it is off a little bit. It does look overvalued, but you have to also remember that this is an unprofitable company. So For unprofitable companies, it's normally better to use the price to sales metric as, over versus the price to earnings metric. Where was the other thing I wanted to look at? So yeah, that's that. Now, if we keep moving, we can see here. Is the company innovative? Do they have a moat? I put yes. They are a leader in this CRM space. They make cloud-based CRM software, and so that serves as a somewhat of they are innovative. This isn't like a traditional business model. This is something that's newer, and their moat is they have several different things. One, that they're a leader. One, they have so many customers. Next, they also have the contracts gives them a moat. Contracts. A contract like this gives them accurate predictions of the cash flow they're going to have in the future, right? Because they're longer term contracts, and it's easier to predict what's going to happen. So that also gives them a moat. That could be also something that makes it harder for businesses to switch to another service. So I'm going to give that a yes. Next up, is it a growing industry? I put yes. This is actually one of the fastest growing industries I've looked up. Normally when I do this, it's normally grows between 5 to 10% for an industry. This is saying for the CRM software, or just CRM in general, for the next 8 years, it's going to grow at an average rate of 18% a year. That's very high. So that looks good there. Next up, return on invested capital. I put no, once again, because it's negative, so that doesn't look good. Healthy margins. This one is, I put no because it is negative. They are losing money, but it is improving. So keep that in mind. They went from negative 15% operating margin, to negative 12% operating margin. So that's getting better. And if we look at, if you want to see their gross margins, you can see negative profit margins, but gross margin of 80%, that's a lot. That's really high. So right now we're at negative 12% operating margin. If that keeps improving, then, that'll be, they have the potential to have really nice profit margins because that gross margin is so high. So just something to, I would keep an eye on that operating margin. Next up, healthy cash flow. I put yes. So even though they're unprofitable, they still have positive operating cash flow. Okay. They're just investing a lot back into the business, and which most companies do when they're growing. You get to spend on sales and marketing to be growing over 30% a year, and free cash flow looks nice. Before the pandemic, it was growing, and then they had a minor setback from the pandemic year, and then now we're back at over $140 million of free cash flow. So that looks good there. Then do they have diverse revenue streams? I put yes. They have over 111,000 customers. So I couldn't find the customer concentration. I couldn't find like what percent of revenue was coming from which customers. That's always something that's important. But they do have a lot of customers, and they also this is another important thing. About half of their revenue comes from the US, and the other half comes from outside of the US. And I think they work with around I want to say 150, at least 150 countries around the world. So that's also a good thing too. Balance sheet. This was one problem. This was not good. They have more long-term liabilities than assets. So that's going to get a no. That's not good. That means they got some debt. But current assets were good. And then this was another problem. This is why I still think this company is overvalued. And that's because of the equity relative to the market cap. So the equity on this company is only, your equity is only 489 million. You're getting 489 million, but you're paying 14 billion for a company that's growing revenue 30% and going to do around almost 2 billion in revenue, or less than that actually. Yeah, 1.7 billion, and they're losing money. So it's going to be years. It's going to be, it'll probably be 2 years, 3 years, maybe 4 years until they start making bottom line profit. And so all you're getting is, so you're going to be, if you buy this for 14 billion, you're going to have, you're going to be losing money from net income, and then you're only getting 490 million on the balance sheet. So that's not a good deal to me. That's why I think it should I think it should be, if it was priced at I think this company should be under $10 billion. When it's trading at, let's see, so probably that'd be closer to half. I would say around like $70. If it was down here around $70, I think that's more where it deserves to trade at. Just because that low equity. So that's, oh, then here's their other, these are also the, these are the solutions they offer. So you can see they have all these different things that works for customer service and sales solutions to help organizations address the rise in customer expectations and craft their customer experiences into a competitive differentiator. Zendesk solutions, blah, 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 blah. So in other words, they have all these different things: Zendesk support, chat, talk. They also have these other ones down here. And so it pretty much just helps businesses communicate better with their customers. And that's an important thing. So that's probably going to be something that sticks around. If we keep going down, we can see this was another thing that, well, this is to be expected too. This is why it's hard for unprofitable growing companies to look too attractive on paper. The number of shares went up 3.5% from last year. Not that bad. That's, if it's a couple percent, it's not that big of a deal. It's so like company like Palantir, they're a growing software company, growing 30%, and they increased share count or number of shares by over 100% last year. So 3.5% is nothing, but it is still headed in the wrong direction, and they're not paying a dividend, so that's going to get a no, unfortunately. Are insiders interested? This was another thing that was not good. Insiders own 1% of the company, and they also have not been over the past year, the same amount of, here we can look it up, the same amount of people buying is the same amount of people selling. So there's no, overall it's almost it's almost the same. That's why that's not really a good sign. That means, I don't know, I just don't think it's, I would not pay $14 billion for this right now. On a price to sales metric, it looks really cheap, but on a price to earnings metric, it doesn't. But see, look at, they're actually, so there's 9, not last month, 9, and then there's 10 sells, 9 buys. So, nothing too convincing there. And then finally, is it founder led, or does it have good management? I put yes, it is founder led. That's a plus. That's a good thing. So overall, this gets a 10 out of 18 score. I'm considering this not a buy. Remember, it's always harder when the company's not profitable because it hurts all these things like return on capital and the margins and all that stuff. But I mean, that means it should be improving net income. It should be getting more profitable, right? Which it kind of is here, but still, it's not. Those aren't healthy margins. This was another problem. They should have more long-term assets and liabilities. There's no reason that they should do that. That's putting them in a position of weakness. That's not good. And then, I mean, this one is to be expected, but then insiders should be buying. Insiders should be buying. If they're really trying to convince investors that the future of this company is going to be one worth investing into, the insiders should be buying. And if they hit a couple of those things, they improve net income, or the PE was if the valuation came down a little bit, then that one would get a yes. What else? If it had a more healthier balance sheet, then it would get a 13. It'd get a higher score, and then it might be considered a buy. But at these prices, I don't consider this a buy. I think it's a good company with a promising future, but not at these prices. I don't think it's worth. I would say around $70, 70, maybe $80, but over that, I don't think it's worth investing into. So I'm not an advisor, but I'm just here to provide some information. So I will see you guys in the next video. Thank you for watching. And I also want to say that once I get to 1,000 subscribers here, I'm going to give out some prizes to a couple of subscribers. So just keep that in mind.